I was about to invest $500,000 in Dubai real estate. Then I ran the real numbers and everything changed. I had the developers agreement printed, the payment plan mapped out, even started imagining weekend getaways to my beachfront investment. But before I hit send on that transfer, I decided to run the numbers, not the sales pitch numbers, but the real long term investment math. What I found made me walk away and choose something else instead. Today, I'll show you exactly what I discovered so you can decide for yourself whether Dubai property is the gold mine everyone claims it is, or is there a smarter path to the returns you are actually seeking. Even if you have already been told Dubai is a can't miss opportunity, and even if you're worried you might be missing out on the next big thing, don't worry. By the end of this video, you'll have the clarity to make the right decision for your situation based on facts, not fear of missing out. Let's be honest, Dubai real estate makes perfect sense on the surface. Tax free rental income, no capital gains tax, a booming expat market that seems to grow every year, world class infrastructure that puts most cities to shame, and the developers make it incredibly easy. 50% off plan, 50% on completion, payment plans that stretch over years. Plus, there's a lifestyle factor that is undeniable: beachfront views, luxury amenities, golden visa benefits. So, why would anyone walk away from what seems like a perfect investment? Here's what happened. I'm sitting in my office in DIFC looking at this beautiful brochure of a 4 bedroom villa. The sales presentation was flawless. The location was prime. The numbers looked attractive at first glance. But then I remembered something I learned during my 15 years in private banking. The most expensive mistakes happen when you fall in love with an investment before you understand it. So I did what I always do with my clients. I modeled the real estate numbers. I took a realistic $500,000 apartment in Dubai Marina, not the cheapest, not the most expensive, just average market price for a decent unit. The gross rental yield looked attractive at 5.5% per year. That's around $27,500 in annual rental income, which sounds pretty good. But then I started adding the real cost that somehow never makes it into the sales presentation. Service charge that's typically $3,000 to $5,000 per year, depending on the building. Agents' fees for finding and managing tenants, another 5% of annual rent. Vacancy periods, because even in Dubai, apartments don't rent themselves instantly. Budget for at least 1 month vacant per year. Maintenance and repairs, because luxury finishes need luxury maintenance. Property management fees if you don't want to deal with tenants' call at midnight, and don't forget the 4% Dubai Land Department fee you paid upfront, which needs to be amortized over the holding period. After all these real costs, that attractive 5.5% gross yield dropped to about 3.8% net. And that's before we factor in inflation and the reality that most of us don't just live in Dubai. We plan our lives and legacies in other countries where the costs are in US dollar, GBP, or euros. So the real value of those dirham returns depends on what they can actually buy over time. Then there's liquidity. If you need to sell, you're looking at 6 to 12 months minimum, assuming the market cooperates. There's no quick exit when you need your capital back. And here's the part that really made me pause: market risk. Dubai delivered over 28,000 new residential units in 2024 alone. That's a lot of new supply hitting the market. When supply grows faster than demand, what happens to prices and rents? Now I know what you are thinking. Dubai property has surged in value over the past few years. And you're right, prime areas have seen impressive gains, with some locations doubling or more since 2020. But for those who hold and rent, The real return isn't just the price jump, it's what is left after service charge, agent fees, vacancy, and inflation. And for many, that means rental income is still the primary driver of net gains. The headline appreciation is real, but it doesn't always translate into real world returns once you factor in the full cost of ownership. I sat back and asked myself, is there a better way to get stable, tax efficient returns without all the hassle, risk, and complexity? That's when I did what I always advise: align my own investments with the same structured approach I recommend to my clients. For me, that meant a diversified portfolio of structured notes. Now, for those who might not be familiar, structured notes are hybrid investments, essentially bonds combined with options, issued by major global banks like JP Morgan, UBS, Goldman Sachs, and Citibank. These are not exotic investments. They are part of a multi-trillion-dollar market that's been backbone of private wealth management for decades. Here's what makes them interesting. They can offer annual returns in the range of, say, 8 to 12%. And I'm just giving you examples here, not promises, while providing various levels of principal protection. Think of it like this: a structure note is like a contract that says if the market does X, you get Y return, and your principal is protected up to Z. No guessing, just terms. Some structures come with a 10%, 20%, or even 30% downside buffer. Now, that's not standard, and most people choose differently depending on their risk profile. The point is, you get to decide your comfort zone, and it's built into the terms upfront. No tenants to manage, no maintenance call, no legal complications across international borders. They are fully regulated, held in your brokerage account, and offer global access to markets and strategies that would be impossible to replicate on your own. And unlike real estate, if you need liquidity, you can typically exit in 1 week, not 12 months. Yes, they are less tangible than owning a physical apartment with a view. You won't get that Instagram shot of your balcony overlooking the palm, but you will get something quieter, more valuable: the confidence that your capital is working exactly as planned. But as a pure investment, the mathematics becomes very compelling. Let me share what I actually did with that $500,000. Instead of buying one apartment in one building in one city, I allocated the capital across a diversified portfolio of principal protected structure notes. Different underlying, some linked to equity indices, others to commodities, some to currency basket. Different maturities, some 2 years, some 3 years, some five. So I have regular capital coming back that I can reinvest or use as needed. The average expected return across the portfolio around 12.6% annually. Not flashy, not guaranteed, but based on clear contractual terms with major financial institutions. That's when it hit me. This wasn't just an alternative. This was the missing piece, a way to grow wealth without gambling on a single market, a single tenant, or a single developer's promise. More importantly, I sleep well at night. I am not worried about Dubai's property supply. I am not concerned about finding tenants or dealing with maintenance issues. I am not stressed about currency fluctuations or geopolitical risk affecting one specific market. Now, let me be absolutely clear about something. This isn't about saying Dubai real estate is bad. I live here. I love the city. The growth story is real. The infrastructure is world class. And for many people, owning property there makes perfect sense. If you want a second home where you will actually spend time, if you're looking for lifestyle and legacy rather than pure returns, if you have strong personal or business ties to the region, Dubai property could exactly be right for you. But if you are investing purely for returns, safety, and simplicity, if you want predictable income without the complexity of international property management, there might be a smarter path. Here's something worth asking yourself: if the stock markets crash tomorrow, like they did in 2008 or in March 2020, how much of your investment capital would you actually lose? Most people think diversification across different stocks or funds is enough protection. But here's what I learned: real protection means knowing your worst case scenario upfront. For example, with structure notes, you might choose a structure where your original money is safe unless the market falls by more than, say, 30%. So even if the market drops 25%, you don't lose a penny of what you have put in. Plus, you're still receiving your regular income payments, regardless of what the market is doing. And that's not a maybe. It's written in the contract backed by the bank. Compare that to owning stocks directly. If markets fall 30%, your portfolio falls 30% too. And your dividend income often gets cut or eliminated entirely. With structured protection, that same 30% market drop leaves both your original investment and your income stream untouched. How often do you get to know with precision what return to expect and when to expect it? With the right strategy, you can know before you invest exactly how much income you'll receive each quarter and under what conditions. It's not an estimate, it's a pre agreed outcome. That kind of predictability can change how you plan, how you sleep, and how you feel about the future. I realized that what I really wanted wasn't a Dubai villa. What I wanted was predictable, protected growth that I could count on. I wanted to stop guessing about my investments and start structuring them. That $500,000 is now working harder with less risk and zero management headaches. Instead of hoping my Dubai tenant pays rent on time, I receive regular payments from global banks. Instead of worrying about Dubai's property supply, I have diversified across multiple markets and strategies. The lesson isn't that real estate is wrong and structure notes are right. The lesson is that every investment decision should be based on your actual goals and not what sounds exciting or what everyone else is doing. If you're like me, if you have worked hard to build wealth, but sometimes feel like you are still guessing instead of strategizing, then you understand why clarity matters more than complexity and why structure beats speculation every time. At Quadra Wealth, we help successful professionals replace investment uncertainty with systematic protected growth, not through hype or promise, but through the same structured approach that ultra high net worth families have used for generations. If you ever feel like you are guessing with your investments, I made a video just for you. It's called Stop Guessing Predictable Wealth with Structure Notes. In under 30 minutes, you'll discover how to replace stress with strategy and build wealth you can actually count on. I will drop the link in the description. It's worth every minute. So, whenever you are ready to choose strategy over speculation, I'm here to help.